welcome everybody for taking the time out of the day, especially during this volatile week, and joining us. We're really excited to get going. Going to do a couple of bits of housekeeping, and then we'll get started. On the call with us today, who's going to be leading us, is Kevin Lane, the founder. I want to mention there are a few of you that have, actually a bunch of you, who have been with us through thick and thin over the last couple of years. And there's a lot of new folks. We've gotten a great turnout today. We want to thank you deeply from the bottom of our hearts for staying with us, because as you probably have noticed, the product is much more refined. There's a new team around us, and we are super excited, especially at times like now. Kevin always preached to you guys that we want to take the emotion out of stock picking and ETF picking. And with this four-dimensional now model, used to be two, as most of you know, now it's a true four-dimensional model. We are helping you take the emotion out of your investing decisions. And a lot of folks on the call have told me personally, and Kevin, we've been a great risk management layover to their strategy, and we've been a great idea generation tool, keeping you in names you should be in and keeping you away from names you shouldn't be in. With that said, on the call, obviously, we have Kevin Lane. He's going to go through some of the new things on FusionIQ. The title of the webinar, obviously, is How to Spot a Market Correction. Kevin will go into some slides. All of these slides, guys, will be available, and we're going to email them out to you in a PDF after the call is over. Also, we're going to try to get to some Q&A at the end of the call. There's a little chat box on your desktops. Shoot us questions. We're going to try to get to as many as we can. And again, everybody who's on the call, thank you for your feedback. Everything you send us, questions, comments, concerns, we've looked at them over the years, and it's helped evolve the product. So thank you again for everybody for joining us. With that said, I'm going to hand the call off to Kevin Lane. Go ahead, Kev.
Thanks, Joe. Appreciate it. And again, it's a Friday. Market's been volatile this week, so we do appreciate middle of the day attendance. Before we get into sort of the crux of the presentation and the webinar, and how you can use FusionIQ to spot market weakness, and of course the reverse, and for another day webinar, how you can spot emerging markets strength, is certainly another feature of the system as well. But what I wanted to do is, maybe for some people that are new to FusionIQ, new to the webinar format that we do, as well as some of the existing users and or old users of the FusionIQ system that are now coming back to revisit us, there's been some significant changes, and I kind of want to touch upon those first before we get into sort of our slides, because I think that's really important for you to understand where we are and what FusionIQ is now today as we stand. So the first thing that we do, and this goes for ETFs, individual stocks, is our master scoring. What we have now is a true, as Joe said, four-dimensional master score. We score in the areas of fundamentals, technicals, momentum, and sentiment. Whereas before we were primarily a technical-only model with a few fundamental factors, as we'll delve into in a bit. It's a much more robust system, a much more forensic analysis of the stock, including things like fundamentals and sentiment and momentum. Within that context, I also want to talk about another important feature of the ranking system and the scoring system, if you will. It's called the dynamic factor weighting. A lot of traditional quant models and everything apply a standard weighting. For instance, I'm going to use a 10% weighting for earnings growth. I'm going to use a 5% weighting for free cash flow. I'm going to use a 10% weighting for technicals. And no matter what the market does, no matter what changes in the market environment is, the model still tracks the same variables and weights them the same. So dynamic factor weighting, for a lot of people is a relatively new term. It's been around for a while, but very few practitioners have done it well. Our colleague, Ian Arvin, who works with us and helped design a lot of the model inputs, who's got a resume that speaks for itself, and including, being at MIT for a number of years in the financial engineering program, really helped us shape that dynamic factor weighting approach. And so what that means is simply our algorithm in the various factors is looking at what kind of market environment are we in. And given that kind of market environment historically, let's use an example, low volatility versus high volatility. What factors work well in low volatile environments? What factors work well in higher volatility environments? And the model will shift and weight its inputs. So maybe earnings growth in, a low volatility environment could be X% weighting, but in a high volatility environment, it actually generates negative returns. So it's either not included in the weighting in that kind of environment, or it has a very muted weighting effect. So the model is very adaptive, very dynamic. The numerical score you see behind the scenes has a potential of 70 different fundamental factors it can look at, although in a given month it'll only use 20 to 30. We have about 9 different technical factors, several in the momentum and sentiment category. So the new IQ, when you see that numeric score, is a much deeper dive and more importantly, a dynamic and adaptive numerical score that is changing and not being static, because let's face it, markets change and so should your algo. So I wanted to make that distinction to you. And as we look at Apple sort of as a screenshot from IQ, you can see the master score 44 denoted by that red arrow. And then, of course, you see the gradients of the fundamental, technical, momentum, and sentiment score, and those slide from 0 to 100. So you can kind of get an approximation by where the arrow is placed as to what the subcategories are looking from a scoring perspective. Now, from an ETF perspective, and this is really interesting, we believe that with a high degree of confidence, we are the only company, in our opinion, that rates the individual constituents of an ETF in these 4 dimensions and then rolls up that aggregate ETF score by weighting the constituents and then do it on a cap weighted basis. So for instance, in the XLK, Apple is about an 18% weighting. And so what we would do, instead of just scoring the XLK as an instrument or as an ETF, we will score every holding individually as a stock, and then we will roll those scores up into a composite ETF master score. And so if Apple's score, hypothetically, what we just actually saw it on the previous slide, was a 44. So that means 18% of our master score for the XLK has a 44 weighting. So we match the weighting of the ETF, and then we apply its score based on a cap weighting. But what's really interesting is a lot of the ETF providers that are out there and that try to provide some sort of, ranking or guidance or grade, if you will, or score on an ETF are usually only doing it on a aggregate level. They're taking mostly technical information and just looking at the XLK as an instrument. We're taking Apple's score independent. We're taking Microsoft's score independent, all the different constituents, giving them individual ratings and then rolling them up for a true forensic analysis of an ETF. So I think that's pretty interesting, groundbreaking, and as far as we're concerned, nobody else is doing that. So I just wanted to really touch on that point before we go into the slides, that this is a much deeper forensic analysis than we used to do in the old system. So as we go forward, for those of you who use the system, for those of you who don't, this would be what your login page looks like when you first hit it. We call it our FusionIQ dashboard. Within that, we have headlines and alerts. We have commentary, fast lane commentary that I usually pen. We have sector watch ratings, ETF watch ratings on ETFs. We have, of course, your custom watch list that you can create. But the dashboard is really meant to be the heartbeat, or the epicenter, if you will, of how we see the world, how we see the market, translated through unbiased, independent analysis. And you'll be amazed at how simplistic, as we go through some of these slides, but yet how obvious, due to the numeric valuations deteriorating, how it was probably fairly obvious that this correction was coming, or that the market was vulnerable to a correction given the weaker underpinnings of the marketplace. So this is a close-up look at what your headlines and alerts on our dashboard would give you. And over time, we'll be adding more sort of unique criteria, but you'll get your aggregate new timing signals. So when you log in, it's going to say today in FusionIQ, there are 8 new positive timing signals, and in this case, 101 new negative signals. And the casual observer will notice throughout time that when the market is good, you're going to see obviously a imbalance with more positive timing signals than negative. And when you're in sort of a neutral market, they may sort of mirror each other. And then of course, as things start to deteriorate, you'll start to see more one-dimensional, technical only negative timing signals. The other thing I think which is interesting, and we'll get into this later, but it gives you an indirect approximation of the market. So when we're looking at individual stocks, we consider greater than 70 to sort of be the more favorable decile classes, 70, 80, 90, 100, if you will. So of course, then tracking how many stocks in our IQ universe are ranked greater than 70, or i.e. perceived to be good, is clearly something that's important to track. And just to give you an idea, when the market was really racing ahead in 2013 into 2014, I think the S&P was up 30 some odd % that year. On average, we were north of 1,500 stocks with a master score, 4-dimensional master score greater than 70. So that meant a lot of stocks were doing really well. As you can see, presently, there's only 181 stocks out of about 4,500 that have a rank greater than 70. And if you're in the system every day and you're looking at this headline and alerts every day, you start to see that degradation. So I'm only showing you what now is probably the lowest value I've seen, in a couple of years. But had we flipped this table 15 months ago, you would have saw a big number. But the point is you have to pay attention to these things. You have to see that, because what it's telling you is how is the foundation of the market as translated through how many stocks are ranked highly in our master score, i.e. being good. And obviously in a good market, it makes common sense that more stocks should be doing well. And in a transitional market, a trading range market, you'd see less. And then of course, as you are about to correct, you'd continue to see more erosion under the surface. So, but this is a quick way for you to, as a user, see the first sort of leg of that stool. If we go down, and this is the one I love the best, and we talk about it around the office, and for those of you who have been on our calls before, we always used to like to say, we have strong market opinions, but they're loosely held because things can change, data can change, inputs can change. You could go out today, the weather's great, and tomorrow you could have some cataclysmic weather event. So you can't just be locked into a forecast. What I love about the beauty of the sector watch table, and these are the 11 major market sectors as done by Morningstar North American industry code classifications. So we have 11 sectors, technology, all the way down to energy. Now, when you're aggregating, and again, this is another roll-up like the ETF scores. So what we do is we take every stock that's considered part of the technology group, every stock that's part of the healthcare group, and we come up with a simple average to get that score. So for a sector score, since you're never going to get a 90 sector score, because with a broader swath of stocks, you're always going to have enough poor ones and things of that, or neutral rated ones to keep the average score low. So for our sector watch threshold, if you will, for kind of determining good and bad, we use 55. So just looking at this, you've got not one sector out of the 11 S&P sectors presently greater than 55 IE, which would be considered strong. So not one. And we're going to look at just as recently on the next slide of December 15th comparative to where they were then, where they were now. And they had deteriorated quite a bit then as well, and clearly had flashed some signals. And what I like to say is if somebody catches a cold, that's one thing. It's not really that bad. If somebody else catches a cold, it's no big deal. But it can quickly go through the system, and all of a sudden everybody has a cold. When everybody has a cold, it's a problem. Corrections, shallow corrections start, of course, when in a shallower correction or normalized correction, you're always going to have something strong, something hold up. But when they start hitting everything, that's when you're starting to get more into, a scarier correction, if you will. And as we looked on December, I'll go to the next slide now to do the comparative of what the sector watch table looked like on December 15th versus now. And you'll see at that particular point, we had technology at a 60, we had consumer cyclical at a 55, consumer defensive at a 55, right on the threshold of good versus bad. So let's call it 8 out of 11 sectors were less than 55 on 12, 15, 15. Now, for a reference point, when you get off this call, look at where the S&P was or some popular index or some stocks in your portfolio on 12, 15, 15, and look at where they are now, and you're going to see a significant difference. I had penned a Fastlane commentary. For those that are subscribers, you can look it up. December 15th, it was called Special Edition Fastlane Market Update. And I talked about the large number of timing cells versus negative timing signals versus positive signals. I talked about the fact that there were only several hundred stocks ranked greater than 70. But then looking at a broad swath, looking at the whole market, and then I said 8 out of 11 sectors are below our 55 level, or i.e. have caught the cold, the virus. And to me, there's no holy grail, and that doesn't mean I'm right, but I always err on the preponderance of evidence. And if 8 out of the sectors are weak and only 11 are strong, that to me is a pretty good indication that there's significant deterioration. And if you want to go a step further, you're calling consumer cyclical and defensive on 12, 15, 15, basically about to cross because they're right at the 55 level. So you could almost call it 10 out of 11 at that point. But, to be transparent and with the numbers, it was 8 out of 11 below 55. And so we were starting to write in our commentary and sort of pontificate that the data is stacking up against you. The data is suggesting the path of least resistance is down, et cetera, et cetera. Now, if you translate that to where we are now, and before actually, if I go back to the sector watch table on the left, I want to point out and look at the 30-day change in master score, with the exception of a couple that were flat, -4, -5, -3, -4. So not only were only 8 out of 11 sectors falling, but their composite sector master score over from the previous 30 days was also had a negative delta or a negative change. Compare that to today. Like I said, now we have no sectors that are greater than 55, and you can look at that two ways, or as I like to say, you can look at it two ways. At some point, when things get overly bad, you reach that capitulation, that washout level, et cetera, et cetera. However, I look at it at this level because we're 5 years from '09, or well more now, 6, 7 years off the low as we head into 2016. And generally speaking, with fits and starts, if you look at a chart from 2009 lows to present, it's generally up and sloping to the right, with some struggles along the way. But it's been a 6, 7 year bull market for the broad market, and we're at higher levels than we were in 11, 012, 010, 09. And you're getting this massive sort of breakdown, 11 sectors negative out of 11 now from higher levels. With, if you wanted to give it some context, a bull market that you could say is a little older or past historical norms, with the median averaging so many days, this one being beyond that. And so you start to put that mosaic together, and you can see it translate through the data, which I love, because it allows me to filter out all the noise when somebody says, oh, earnings are going to be good, or that's going to be good, or this could be great. That's all subjective opinion. Nobody really knows. the data doesn't even know, but I don't make the numbers. The numbers make themselves, and they translate the market action. So I can see the transition from strong to mixed to weak. And if you want to start taking that further, and now this, for those of you who aren't subscribers, this is what you would see when you look at our S&P Spider chart, with the top half being the S&P 500 Spider ETF, and then the bottom graphic being our master score with that red line, which is user defined. We defaulted to 55 on ETFs, 70 on stocks, but you have the ability to change that threshold level if you want to make a visual correlation between markets, stocks, ETFs, and that threshold line, because you may want to play around with it and do something yourself. But our default is 55 for ETFs and 70 for stocks. And so if you look, you were generally sideways. I should have probably went back a little further, but we're here from January to present. And you can see the first sort of red arrow, which was ahead of the August correction, which was fast and furious, not to quote the Vin Diesel movies, but the market was fast and furious correction then. But you can see markets were stable, slightly upward or sideways. When we went below 55, of course, that preceded that summer correction. We had a subsequent rally where you had a cross back above the 55 threshold. The market had some lift. And then I don't have, unfortunately, because this is a JPEG and I'm not on the actual site right now, I don't know the exact day there, but as you can see, we had the cross back below 55, and subsequently, we've had a pretty rough sledding for the last 2 or 3 weeks. And as you start to go through and look at more ETFs, look at the industrials, same thing. You slip below 55, August correction, got the recent slip below 55 on the 4-dimensional composite ETF master score. And remember, that score you're looking at is a reflection of the individual scoring of each constituent of the die or the SPY, and then cap weighted to mirror the index. So we didn't just look at the die as an instrument and try to rate that. We give a forensic analysis to all of the instruments within it on an individual basis and then roll it up for that master score. So the point I'm making here is, as you would look at charts, as you would use IQ, as you would use the dashboard, you would have started to see this deterioration. Maybe not day one it started, but little by little, more and more, you'd start looking at charts and saying, well, geez, that just went below 55. That sector went below 55. That sector went below 55. Start looking at your portfolio, because obviously your portfolio will have constituents, whether they're ETFs or stocks, that belong to those sectors or are influenced by those sectors. You go down to the transports. Now, the transport is a narrower based ETF. Obviously, the S&P 500 has 500 constituents. The transportation average, I believe, don't quote me on this, is 20 some odd or whatever. But UPS and FedEx, I think, make up like a 40% weighting. So you'll notice in the master score here, you did have a lot of volatility. I would call it a lot, but a little volatility around that 55 threshold, where you had kind of some little bumps up and down. It's not as smooth. The composite master score for a narrow-based ETF won't be as smooth, and will be prone to a little more volatility if they have heavier constituents. But as you see, you kind of had this theme of dropping below 55, hovering around it, dropping below again, and of course, the most recent drop below 55, and now you're at a 52-week low. So I always believe pictures tell a story, or tell 1,000 words, if you will. And you see below 55 and weak, below 55 and weak, below 55 and new 52-week low. There's an old adage, or a lot of things, where people call, and for those of you who listen to past webinars, we've had what we used to term our risk on, risk off metric. And risk on just means when the markets usually do good when riskier asset classes are rising, and when less risky asset classes are outperforming. It tends to suggest people are getting more defensive, more conservative, and when people tend to get more defensive, more conservative, if you will, markets typically don't perform as well. So by looking at the SPHB, which is the Power Shares S&P 500 high beta ETF, you can see high beta went out of favor in, call it early June, mid-June, and has never looked back, stayed below the 55 level, and is now at a new 52-week low. And so again, not to be repetitive, but to really drive home the point, visually you see below 55, below 55. Oh, that's interesting. High beta is acting, excuse my French, like garbage and has a numerically low score in FusionIQ. And so you start to piece all these together, and so under the surface, you start to see that here's small cap growth. Again, markets usually do better when small cap is outperforming large cap. Again, it kind of allies into that. People are comfortable with risk, comfortable with the market outlook, comfortable amping portfolio beta. But you can see the S&P 600 small cap growth ETF SLYG dropped below 55 and has dropped like a stone recently. So the data just kind of hits you over the head. And the last slide before we open it up to some questions I wanted to show is here's one that an ETF that's actually doing better or is ranked greater than 55. And again, it makes sense. You know, and it's I'm not sure. Let me see if I can't remember if I labeled this right. I think. Hold on one second. Yeah, so this is Staples. I labeled this wrong. This is Staples. That's what I thought. So Staples, consumer staples is obviously a defensive sector. So when you start to build that puzzle in your head, high beta doing poor, consumer staples, the defensive sector is ranked high. But I think the one that does it for me the most, and it's such a simple process, is just watching these numbers change when more sectors are doing better, i.e. ranked greater than 55. You can make the general assumption that the market probably is okay when they're more doing worse. And you see that transition in the numbers if you're paying attention to the system. So in essence, this becomes almost a de facto risk management, quasi timing, market timing, if you will, because what it does is it speaks to market breadth. Are we on stable footing? Yes, 9 out of the 11 sectors are ranked greater than 55. Are we on stable footing? Not really, only 5 sectors are greater than 55, 6 are we on stable footing? Wow, 9 out of 11 are below 55. That's not good. How you then choose to implement that knowledge, hedging, selling, buying options, what have you, inverse ETFs, that's part of your portfolio process, of course, and how you do things. But this allows you to kind of see the changing environment translated through numbers. And with that, I'll open it up to questions, Joe.
Thank you, Kevin. A lot of good questions, folks. Just so you know, the slides are going out to you after the call. And for the FusionIQ guys inside on the call with us, I think it makes sense, and a couple of people mentioned it, let's send the slides out going forward so people can see these numbers better and they're in front of their own screen. So we'll do that.
Makes sense, yep.
Yep. Now, there's a couple of guys that have been with us for a long time have a couple of good questions, but I want to start first with the new guys.
Sure.
A couple of people have said, okay, I'm very active in ETFs and individual and stock sector rotation strategies. If I'm using FusionIQ and logging in for the first time today, how would Kevin suggest that I start to approach the system, and what should I do, like 101, if I was him? And it's a good question, Kevin. If you want to, like 60 seconds, kind of like outline, if you were new to IQ, what would you really look for first?
Well, I'm assuming you're seeing my screen now. I brought IQ up in front of me.
Yes, we can see it. Yep.
So let me just log back in. I seem to have timed out, so I'm just logging back in. So for me, I think the most important thing, and to answer this question specifically, as an ETF trader or trading ETFs or investing in ETFs, We do have an ETF watch, which kind of are we have the sector spiders, technology, consumer, discretionary, utilities, et cetera, plus the diamonds and SPY. So you can get a quick sort of rundown here. So I think I would watch this table here. I would also keep eye of the sector table, because the sectors are a little broader based, and sometimes you'll see the weakness develop in the sector because they'll have small and mid names in a broader sector versus the ETF, which tends to gravitate towards more of the larger market cap sector. So you may get some initial clues about pending weakness in the ETF by looking at the sector first, because the weakness, when weakness trickles into a market, it's it's kind of the National Geographic thing. The hunter goes after the leopard goes after the weaker prey, if you will. So you tend to see weakness in the smaller and mid issues within a sector before it affects the mega caps. So I think you could look at the sector watch and then the associated ETFs and kind of watch those in tandem, and obviously set up different watch lists and things of that nature. That's how I would approach it. And there is a whole ETF center here. And I will answer one question before we take another one about ETFs specifically, Joe, because I did happen to see the question. Somebody had mentioned, why don't we score that many ETFs? And I think if you go back to the ETF center, it says 469. Whereas in the old system, I think we scored 2,000 ETFs. The difference is, in the old system, the ETFs, for those who may or may not remember, the ETF was only a technical only score in the old system, and it was a technical only score applied to the actual ETF instrument itself. In order for us to score an ETF and feel comfortable to put it in the system, it has to be an ETF that has stock holdings. So in other words, the VXX or the VXN that track the VIX, they don't hold securities, stocks. So we cannot have a four-dimensional technical momentum sentiment fundamental score. So we only score ETFs that hold actual equity holdings.
Thank you. This comes from an old subscriber. Dave, great question. Hi, guys. Long time no speak. Does spotting a market correction include a reversal, or is it just to the downside? And I think it's an interesting question because we're getting that asked a few different ways. Go ahead.
Yeah, I again, and for those of you who know me, you'll probably know my typical response. Partly, it depends on your investment style. I can't speak, for everybody on the call. I can speak for myself and how I view the world. And some people like to try to buy the falling knife and be early. Some people, I like to say I'm more of a scaredy cat, if you will, from an investing standpoint. I let everybody try to be a hero, try to buy the falling knife. I wait till the battle has been won and the market has turned. And by turned, I mean seeing more stocks in the sector watch column be greater than 55 than less. I want to make sure it's a true turn so I may pay a little later than the person that buys early, who I could say got lucky as well, because there could have been 5 other people that bought early and watched it go down another 10, 12, 15%. So for me to see a turn and to spot a real turn, a turn that I think is going to be durable and worth putting capital back to work on the long side after a correction, I would want to see something like 7 out of the 11 sectors back above 55, all with positive score, 30-day score changes, with more new timing positive signals and negatives. So I can only speak for how I see the world, and I would want to see a majority of the sectors be back above 55 to suggest to me that the turn was true.
Along those lines, Kevin, this is an old subscriber who you know well, and his point was we always want to see what Kevin's doing in the cockpit. How does he use FusionIQ himself, and kind of looking over your shoulder? So it's a great answer. Along those lines, let's talk to some of the older subs, and some newbies I notice are asking a similar question, and it's a good question. How do you spot for example, if energy is ranked at 28 or whatever it is now, how do you spot? You're not going to wait for 55 or across a 55. So maybe you talk about the timing signal a little bit and how it can help you get in and out when you're seeing, for example, energy so over, quote unquote, oversold. I don't like to use that term,
Right.
but they want to know, like, you're not going to wait till 55 in order to go long again. So you want to talk a little about the signals?
Well, you know, I view the world as a purist. And for me, again, I'm talking about myself, the timing signals are purely technical only. It's for trading purposes, what have you. The four-dimensional master score is more of a forensic, intermediate to longer term analysis, if you will. Me, I look at it this way. If the sectors are turning up, I still want to be in the highest sector because I believe that the higher sector will do better. So if energy goes from a 28 to 40, great, but technology goes from a 55 back to a 60, I want to buy technology. I want to be overweight the best, and I still don't really want to have any exposure to energy. Now I'm going to pay up at 55, but again, for me personally, anything below 55, I would view as being early and vulnerable to not being a true turn yet. But certainly people that like to be active traders could use a low score like energy at 28. Although a lot of people that I've had conversations with tried to say that 2 months ago when energy was a 30 or a 28, and then they had another big leg down to new lows. So I think it all depends on your investment style. Look, if you're looking for a trade and you think that 28 is, obviously pretty washed out, especially given the decline they've had, the multi-year decline, and you start to see maybe 15 new positive timing signals in the sector and no new sells, and you want to try to play that for a short-term trade. But from a portfolio perspective and looking at not a short-term horizon, me personally, I would still wait to see that turn, or I would look for the greater than 70 in the weak sector to buy.
Mm-hmm. Along those lines, Kev, if you could pull up one ticker symbol in the box, and it's along these same lines. Discuss how a stock like AMBA, Apple, Mary, Boy, Apple, Ambarella, which is a semi-name, how with such a low score can it become a positive timing signal? This is for somebody new, so maybe you explain to them the difference.
Yeah. So, and going way back into the archives. When we built the system, we had our numerical score. The numerical score, always think of the numerical score as more of your longer term, intermediate term navigation. You may go from here to California, mostly on a specific highway once you get to a certain spot going, west on whatever route that is. But that doesn't mean the navigation to save time won't take you off that main road for a little bit here and there. And when we built the system originally, we had a lot of traders, a lot of PMs, a lot of hedge fund managers that said, look, that's great if, in this case, we'll talk Ambarella specifically. That's great if Ambarella is going to go from 30 to 130. I'm not buying it at 30 and holding it to 130. I may buy it at 30 if I'm fortunate enough and smart enough and lucky enough, and it goes to 60, I'm going to sell it. And then if it has some market weakness and then it starts to turn up again, I'll buy it again. So those timing signals were to help people with shorter term entry and exits in conjunction with the longer term master score as a guidepost. So I would feel more comfortable buying something that was greater than 70 with a new timing signal. I would put more stock in that short-term direction of the 70 with a timing signal than a 41. Now, just because the stock's 41, let's just say Ambarella specifically, maybe this thing can rally 10 or 12 points and its master score moves a little. And then maybe it rolls over again, starts to break down, gets a new negative signal and goes to 10. So the longer term timing signal or the longer term four-dimensional master score will be correct in its negative outlook, but it may have, because it's not looking to catch the little wiggles, but the short term trading signal or timing signal could be advantageous if that's what your objective is to try to catch a counter trend short-term opportunity.
Thank you. Quick question. When would your indicators have gotten you out of XLE, for example? XLE.
Well, one second. XLE, and I'm going to default to the 1-year chart here. But you can see we started the year, and I'll put my mouse over here. We started the year, if you can't see that, it's a composite master score of 37, well below the 55 for a ETF. And we started the year at 76, and as of yesterday, we're now at 56. Now, if I went back further, although our data from a 4-dimensional perspective only starts in January of 15, clearly, if it started the year at 30, the 55 would have been much higher up. But as you could see, we are now at, as of yesterday, 30, and we've had a little rise and ebb and flow in the score. And this is, and this kind of, I guess, maybe dovetails into the last question. You can see here at a 35, and you rallied to 45. You know, from a trading perspective, you went from 75 to 82, but because we weren't above 55, in my opinion, it wasn't a true turn. And of course, then it started to go lower and lower, and so I think that's a nice sort of reason why you use the composite master score or the ETF master score or the stock master score as more of you put more credence in that.
Excellent. Good question. Kevin, how did FusionIQ, without giving up too much of the special sauce, how did you come up with 55 for a sector and 70 for an individual stock?
So,
touch upon that real quick.
So, you know, we originally went off some of the original testing we've done. We will have, you know, a new white paper out in not too short order within this new year. I had mentioned, and if you go to our About Us section, you can read about Ian's background, my colleague at FusionIQ, and Ian is, you know, probably one of the best quants there is out there, and he's in the process of basically quantifying the metrics, talking about, you know, how the high-rated stocks do versus the low-rated stocks. So at present, a lot of the choosing of the thresholds, and remember, we said they're user-defined, so somebody else may find historically on Apple that, you know, looking for crosses above 60 worked better than 70 from a visual correlation standpoint. But we relied on some of the original data we had from some of the original testing, but we may find those threshold levels, suggested threshold levels, could change when we publish that white paper. But to answer the question, it was based on sort of our initial research when we had built the system.
Terrific. Kev, a good question, going back to 08 actually, and this is really, it's timely and we're on record, folks, but Kev, talk a little bit about how FusionIQ, again, it was an older system, it was really technical only, but how it helped us in 08 and 09. Now, guys, some of you guys know that we do have a wealth management business separate from FusionIQ, and we're not making any recommendations, but Kevin is on the record, for example, in the financial sector. People are talking about the financials, Kev. And how did it help? How did FusionIQ help you then and versus now? To note, folks, the financials, we started seeing deterioration, Kev, correct me if I'm wrong, was in 07. Well, it was almost a year, at least a full year prior, but go ahead.
Well, I'm going to do you one better than that. In the About Us section, if you go into the news archive, it is, let's see, where are we? I think it's in one of these.
There's one August 20. There's one on AIG there. But go ahead.
No, that's the Barron's piece. But a long story short, and we can send that out for those that wanted to see it at the time. But basically, deterioration is subtle. The way these indices are constructed, if you're looking at equal weighted, it's a little bit different. But the popular indices are market cap weighted. So until Apple gets hit, until, you know, heavy weighted Dow constituent or S&P constituent start getting hit, But the deterioration starts long before you start to see cracks in the popular indices. And specifically going back to '07, I remember 07, '08, I remember authoring the piece, and it was similar to the concept of looking at the sector watch, and where I talked about, here's the Keefe Bruyette Bank Index, KBW, the big well-known bank ETF. I took every constituent, I wrote my piece, and I said Bank of America is a 32 individual score out of 100. XYZ is a 20. ABC is a 15. And I went through and listed all the banks. And my language basically said, while I don't have a crystal ball, the fact that the scores on these banks are out of 100, 32, 23, 14, 17, 18, 22, that can't be good. Now, I would never insinuate that I knew what the precipice or how deep '08 was, and anybody that tells you they knew that, is full of it. All I knew was conditional elements. I always use that analogy of a doctor-patient. Somebody could look healthy when they walk into your office as a doctor. You start running the tests: high blood pressure, high cholesterol, and all of a sudden, the guy that or woman that you thought looked physically fit, you start running the test. You're like, wow, under the surface, this person doesn't look nearly as good as they do on the surface. And so what I knew was the underpinnings, the legs, the footing that the market was on by those banks being low sent a bad message to the market, much like if you look at the slides, the S&P going to the spider below 55, the diamonds below 55, the transportation's getting hit, the high beta's getting hit, consumer staples on a relative basis outperforming. You could see that shift of asset flow away from aggressive into conservative and things breaking down. So I think that's how I saw it in the banks in particular then.
Very good. And the folks, that is available on the site. You could pull it up. And we don't say it to impress you, believe me when I tell you, and most of you guys know that. We say it to impress upon you that, data-driven, that's what Kevin built the system for. He's been doing it since 2002. He really wanted to take the emotion out of investing and choosing correctly and not being emotional about it. And, let's face it, the volatility this week is back in the market. We've been up off the lows. And we're getting told by a lot of customers that use FusionIQ in their daily process, and I'll say this, and Kevin says it over and over and over, we're not looking to replace your strategy. A lot of you guys are very, very, very successful doing what you do, and you've done it for a long time. What we want to be is another set of eyes in your strategy, a layover worst case, or keep you around great ideas, keep you out of bad ideas sort of thing. But what you'll find is that if you use data, and that's what we've tried to do with FusionIQ, is present the data cleanly and succinctly to you to make investment decisions. We think it could reap a lot of rewards. We've had a lot of people tell us over the years how it's helped them, especially now as we're starting to see this volatility back in the tape. With that said, Kev, there's other questions, kind of housekeeping. I just want to mention, guys, please send in all your questions and comments. We look at them. We're continuing to refine the system. Go ahead, Kevin.
info@myfusioniq.com.
Thank you. info@myfusioniq.com. We eyeballs inside of FusionIQ, folks, see every one of them as soon as they come in, and some of those have helped us evolve the product into a much better product than it was. So with that said, I think we're going to look to do these on a monthly basis going forward. We really appreciate your time today. We want to get everybody back to their desk. But if you have any questions, comments, or concerns, definitely call us or email us, and we look forward to talking to you through the year. And thank you again for your patronage. Kev, anything else?
No, that's it.
Very good. Thanks, everybody. Have a great weekend, and we will talk to you again soon. Take care.